So we are going to look at events which may trigger a pay audit. So the first event A, non-remittance of the pay amounts deducted, non-remittance of the pay amounts deducted, non-remittance of the pay amounts deducted by the employer, non-remittance of the pay amounts deducted by the employer. B, fluctuating and late payment, fluctuating and late payment of the pay amounts deducted, fluctuating and late payment of the pay amounts deducted. C, irregularities detected through the examination of the end of year returns, irregularities detected through the examination of the end of year returns, irregularities detected through the examination of the end of year returns. So let me just read the first three for Thomas, who has just joined. So we are looking at events that may trigger a pay audit. So event A is non-remittance of pay amounts, deducted by the employer, non-remittance of pay amounts deducted by the employer. The next event B, fluctuating and late payment. Fluctuating and late payment of the pay amounts deducted. Fluctuating and late payment of the pay amounts deducted by the employer. Then C, irregularities detected. Irregularities detected through the examination of the end of year returns, irregularities detected through the examination of the end of year returns. Then D, in case of employers whose final accounts submitted to the Revenue Authority, in case of employers whose final accounts submitted to the Revenue Authority, in case of employers whose final accounts submitted to the Revenue Authority, raise suspicion, for instance, where the salaries and other staff expenses, claimed in the accounts, are usually much higher compared to the pay remittances, by the employer, Then E, third-party information third-party information, third-party information about the employer, third-party information about the employer flouting, third-party information about the employer flouting, third-party information about the employer flouting payee rules or regulations, flouting the payee rules or regulations, flouting the payee rules or regulations. Then F, information from the taxpayers, information from the taxpayers unit. So the taxpayers recruitment unit, information from the taxpayers recruitment unit, information from the taxpayers recruitment unit of the revenue authority, information from the taxpayers recruitment unit of the revenue authority. And finally, G, random selection based on a risk criteria. Random selection based on a risk criteria. Random selection based on a risk criteria. The next subheading, objectives of a payee audit. Objectives of a payee audit. Objectives of a payee audit. So we say a payee audit by the revenue authority, a payee audit by the revenue authority, a payee audit by the revenue authority aims at achieving specific objectives. A payee audit by the revenue authority is aimed at achieving specific objectives, including A, sensitizing of the employers. Sensitizing of the employers on their obligation. Sensitizing of the employers of their obligation to operate. Sensitizing of the employers on their obligation to operate the pay system. On their obligation to operate the pay system. On their obligation to operate the pay system. B, providing assistance to employers. Providing assistance to employers having difficulties. Providing assistance to employers having difficulties in managing the pay system. Providing assistance to employers having difficulties in managing the pay system. C, conducting a verification that pay is calculated correctly. Conducting a verification that pay is calculated correctly. Conducting a verification that pay is calculated correctly, deducted and remitted. It's calculated correctly, deducted and remitted to the revenue authority. Conducting a verification that pay is calculated correctly, deducted and remitted to the revenue authority. D, detecting schemes designed. Detecting schemes designed detecting schemes designed by the employer, detecting schemes designed by the employer for evading of tax, detecting schemes designed by the employer for evading of tax. Next, this should be E, taking corrective measures to counteract, any tax evasion schemes, taking corrective measures to counteract any tax evasion schemes, taking corrective measures to counteract any tax evasion schemes, and improve on tax compliance. Taking corrective measures to counteract any tax evasion schemes and improve on tax compliance. Next, collecting additional revenue by charging tax, collecting additional revenue by charging tax on salaries and allowances, that were paid outside the payroll, Lastly, verification of the correct transfer of pay details, from the payroll to the iTax system. Verification of the correct transfer of pay details from the payroll to the iTax system. So that is pay audit. So we can look at May 2016. May 2016 should be question 2. It's called Worker Enterprises. May 2016 question 2. So May 2016 question 2 is called Worker Enterprises. So May 2016 question 2. Okay, so read the question. May 2016, question 2A says, Weka Enterprises is a small retail business dealing in fast-moving consumer products. The Revenue Authority suspects that the business has been filing fraudulent returns and has requested for financial statements from the business. The business provided the following details for the years ended at 1st December 2015 and 31st December 2014. Income statement for the year ended at 1st December 2015. Turnover, less cost of goods sold, gross profit, proceeds from sale of furniture, capital gain on sale of plot, less expenses, purchase of furniture, general expenses, rent and rates, depreciation on motor vehicle, customs duty, higher purchase costs, salaries and wages, and net profit. Statement of financial position as of 31st December 2014 and 2015. You have non-current assets, furniture at cost, motor vehicle at cost. Current assets, you have inventories, accounts receivable, prepaid general expenses, prepaid rent and rates, cash and cash equivalents, total assets, financed by capital at net profit, like drawings. Current liabilities, you have accounts payable, accrued rent and rates, interest due on hire purchase, total capital and liabilities. Additional information, turnover and purchases were inclusive of VAT at the rate of 16%. The turnover excludes cash sales during the year ended at 1st December. The business paid the following expenses out of cash sales: telephone and postage, school fees, repairs and maintenance, insurance. The bank balance is included in the cash and cash equivalents. The following details were included in the bank statement: personal expenses, general expenses, rent and rates, hire purchase, interest payments to creditors, receipts from debtors. What is this? The following assets. The following assets used by the business were not included in the assets register. So you have computers, fax machines, saloon car, delivery van, computer software. The Revenue Authority has established that the statement of financial position. So the examiner is already giving you a hint that you're going to rely on the statement of financial position. Forms a good basis for recomputing. So you're being asked to recompute the taxable profit, or all expenses are to be adjusted on the basis of statement of financial position required. Using suitable computations, confirm the accuracy or otherwise of the taxable profit of Weka Enterprises for the year. Then summarize 5 types of preliminary information that you might require from the business in order to further ascertain the accuracy of the taxable profit. So prepare a statement So since we are recomputing, the first thing we want to work with is note number one, because we have to look for turnover. So they're saying turnover and purchases were inclusive of VAT. So we first make sure they are not inclusive of VAT. Then note 2 says turnover does not include cash sales. So in other words, the examiner's interpretation here means that turnover will only be the credit sales. Credit sales. So we have to look for credit sales. So the turnover excludes cash sales during the year, and then the business paid the following expenses. So that will give us cash. But first, we have to look for turnover, which is credit sales. Look for turnover. We first get turnover from the statement of financial position. And once we get turnover, we adjust for VAT. We have been told turnover is inclusive of VAT. So to get turnover, you're going to use debtors. So I'll let you prepare a debtors account. So prepare a debtors account. They call it debtors. Let me check the statement of financial position, and they are calling it accounts receivable. The statement of account, financial position, they are calling it accounts receivable. So please try and get our data using the statement of financial position. Try and get our turnover. Try and get this turnover from the statement of financial position. Then we are going to use that. So umepata turnover. Sasa, you look at accounts receivable. Accounts receivable is an asset. Unit debtors, right? That's another name for debtors. So you take the opening balance. Opening balance hapo ni ngapi? 1640. The opening balance is the balance as of January 2015. That was the balance in December.
Yes.
So unit 1640. So you'll debit that opening balance.
Yes. And then credit.
Debit your opening balance. And once that is debited, you will go to the bank statement. The bank statement is in note 3. Remember bank statement?
Receipt from debtors.
There are receipts from debtors for 5890. So those receipts from debtors were debited in the bank statements. No. So you credit here. So they already debited in the bank statement. So you credit in the accounts receivable. Then apparently we don't have any other transaction. So you put the closing balance. The closing balance of accounts receivable is the balances at the end of 2015, which is 740.4. Yeah. So ukiweka hapo, you balance off the account. The balance should give us the turnover. The balance should give us turnover. So this is what we are saying. So we have an opening balance brought down, and the balance brought down was 1640. That's the balance brought down. Then from the bank statement, you get this amount. Receipts from debtors is 5890. So bank 5890. Then you put the closing balance. The balance carried down at the end of the year. The balance carried down at the end of the year is 740.4. Then you close all this. The balancing figure should give us the turnover or credit sales. Let me call it credit sales, so that you know exactly what that was. Yeah? 4990. This is 4990.4. So this total figure ending up
6630.4.
6630.4 and 6630.4. So that can at least start off our statement. So we go back to the statement. Ama, let's get purchases pia kabisa. And then we'll start everything at a go, yeah? Let's get a second working note. This second working note should have to credit purchases. Credit purchases. So to get credit purchases, again, you can prepare a T account for
Accounts payable.
Accounts payable. So this one is a liability account. A liability account. So accounts payable, balance brought down is 1528. So balance brought down is 1528. That's the balance brought down, 1528. Then you go to the bank statement. There's some payments to creditors, and the creditors were paid 2460. So bank, you debit 2460. You credit bank, you debit here. Then you put the closing balance. The closing balance for accounts payable is 979.2. So balance comes down. And we close this and get credit purchases. So if you add this here, we get how much? So 2416,
39.
yeah, we get 34, 39.2, 34, 39.2. The balancing figure is
1811.2.
1811. 1911.2. These figures can help us at least start off the trading account. You can use this to start off the trading account. So go back to the trading account. Go back to our statement. And we go to additional information. Note 1 says both turnover. Turnover here refers to credit sales. Both turnover and purchases are inclusive of VAT. So we'll adjust for VAT as we go on. So we have turnover. And that's the credit sales in note 1. It's going to be 49.90.4 multiplied by 100 over 116. We only take the amount without VAT. So how much is that? Because it was inclusive of VAT. So 100% is the cost plus VAT divided 116, but you take 100 as a proportion of 116. 43. Hakuna decimal, it was a 0.4, huh? 0.07. So hiyo ni credit sales, but kuna cash pia. Cash sales. So cash sales we get from note number 2. It says turnover excludes cash sales. The business paid the following expenses out of cash sales. So all these you just add. You're paid out of cash sales. So if you add 48 plus 142.8 plus 94.6 plus 36.6, we get cash sales. So when they receive cash, they used to pay these expenses. So if you add those, you're going to get something like 322. So together with that, it will give us 4624. 4624.07. That's our sales. 624.07. Then we'll say less cost of sales. So we have opening stock. So opening stock we can get from our statement of financial position. They call it inventories. So our opening inventory is 2881. 2881. To that we'll add purchases. And purchases we are told is inclusive of VAT, so we'll adjust that. We had calculated that in working note number 2. So purchases is 1911.2 multiplied by 100 over 116 to get it without VAT. How much?
1647.
1647. 0.5.
8. 9. You may take 2 or 3 decimal places.
We are doing thousands, so we can put 3 places of decimal. So the summary is 1657.586. 586. Okay, so we add to 2881.
45.8.
We get 45, 58,
45.86.
and 586. Then we lessen closing stock. The closing inventory is given as 4389.6, 4528. This one is 43, closing inventory 89.6. The difference should give us cost of goods sold 4528.586. Okay. So we subtract closing inventory, so our cost of goods sold is how much?
One 38.
138,
0.986.
138.986. So this can give us gross profit. So gross profit is 4485.084 is our gross profit. So after getting gross profit, we'll try and see whether there are any trading incomes. Trading incomes are things like realized foreign exchange gain, discounts received, and those we can only get from the statement they're prepared. So from the statement they're prepared, after gross profit, there are proceeds from sale of furniture. So proceeds from sale of furniture is a capital gain. We are not going to include that because it's a capital gain. Proceeds from sale of furniture. Capital gain on sale of a plot, we are also not going to include that. In other words, we will only deduct expenses. They are not trading incomes there, so there's allowable expenses. Less allowable expenses. So we'll be comparing with what they have, but we'll be recomputing ours, just like we've recomputed everything here. If you look at their statement, the first expense they've deducted is purchase of furniture. We know we cannot deduct purchase of furniture, so we leave out purchase of furniture. The next one is general expenses, which we are going to recompute. General expenses. So let's recompute general expenses. So how do you compute that? We go to the bank statement. So in the bank statement, there are general expenses paid, and what they paid is 792.8. So 792.8. Then you go to the statement of financial position. We have prepaid general expenses and current assets. Prepaid general expenses and the current assets, we need to adjust for those. So prepaid general expenses, opening balance at the beginning of the year, prepayment brought forward. So prepayment brought forward at the beginning of the year is no longer prepayment. So you add 24.6. That's prepaid rates. You add 98. For prepaid general expenses, you add 98. Then you subtract prepaid at the end of the year, 178.2. So there's a prepayment of last year. That one you earned. Then at the end of this year, prepaid, you subtract. So plus 98 minus 178.2. So that gives us 712. Is that okay?
It's 178.4.
So that's general expenses. The next one is called rent and rates. Again, you start from the bank statement. How much was paid for rent and rates? And for rent and rates, you can get the much that was paid for rent and rates, and they paid 68.4. 68.4. Then you come to the statement of financial position. You pay general expenses. No, yours has an error. Me, I'm using the original question. So yours must be having a typing. I've tried to correct those errors. When I forward, maybe somebody doesn't correct. I don't know why the errors keep recurring, but I'm using the original paper. Yours was typed. So when I tell you it's 178.2, that's exactly what it is. So rent and rates from the bank, it is 68.4. Then you come to current assets. They are prepaid rent and rates. Prepaid last year, you add 24.6. Prepaid at the end of this year, you subtract 72.8. 72. Then under current liabilities, we have accruals. Accrued from last year is 36, so you subtract 36. Accrued at the end of the year is 24, so you add 24. That's how we get rent and rates. 68.4 add prepaid year last year, 24.6. Subtract prepayment of this year, subtract accrued last year, add accrued this year. And the result is 8.2. The next expense, they are calling depreciation on motor vehicle. Now, depreciation is not allowable as an expense. Then they have customs duty, which they charge. Customs duty is a tax. All taxes are disallowable. They're not allowed as expenses. Then you have higher purchase interest. Again, we start from the bank statement. Higher purchase interest from the bank statement is 29.6. 29.6. Then we come to current liabilities. There's interest due on higher purchase. Interest due last year, you subtract 28. You add interest due this year. This year is 16. To get higher purchase interest. This is 17.6. Then you have salaries and wages. So salaries and wages has no information to verify, so you cannot recompute salaries and wages. You just put it the way it is because there's no separate information. You don't have information in the statement of financial position or in additional information to verify salaries and wages. Then we come to the other expenses that were paid out of car sales. You'll find them in note number 2, like telephone and postage. Is 48. telephone and postage. School fees is not allowable even though it was paid. We'll deduct repairs and maintenance. Repairs and maintenance. Repairs and maintenance is 94.6. Then you have insurance. Insurance is 36.6. So from there, we bring in investment allowances. So investment allowances will go to the statement of financial position and get the assets there for purposes of computing. So investment allowances will go to non-current assets in the statement of financial position. So we have non-current assets like furniture. So we can compute for furniture. I'll put the opening balance of furniture at the beginning of the year. It was 460 opening balance of furniture, 460. Then you look at the income statement. They're saying there are proceeds from sale of furniture, 240. So I'll subtract 240 because they sold furniture. But then I'll add under expenses this purchase of furniture of 360. So this should give me the residual value or whatever is left. Then the rate for furniture is 10%. So out of this, get 10%. 10% will be the rate. So 460 minus the disposal plus acquisition of 360. So 10% will be 58. Still under non-current assets, we have motor vehicle. So motor vehicle opening balance is 1564.4. So 1565. 1565.4 is motor vehicles. Now there was no purchase of motor vehicles. However, there was no additional purchase of motor vehicles. So opening balance is 1564. Then we look at note number 4. So note 4, in note number 4, they purchased a saloon car. That's still a motor vehicle. So I'll add this, I'll add 2800 for purchase of saloon car. So saloon car nitaongezea hapo, then I get 25%. So 1565.4 plus 2800. This will be 1091. 35. So that's what the assets that were already recorded. So those were assets in the statement of financial position. Then there are more assets in note 5, note 4, like computers. So for computers, the cost is 368. They are not included, so 368, we get 25% for computers. 368 is 92. Then you have fax machine. Fax machine is simply other assets. So 120, you get 10%. Then you have delivery van. Delivery van is 720. Computer software is 150. So those are the allowed expenses we can deduct and be able to get profit or loss. So that's the investigation or the audit. Our next investigation will be back duty. Oh, there's a second part of this question. You need to answer. The B part is asking about preliminary information. So let's first answer that. So B is saying summarize 5 types of preliminary information that you might require from the business in order to further ascertain the accuracy of their taxable profit. So what other preliminary information would you require to ascertain the accuracy of the taxable profit? Now this is important because of a lot of differences between our computation and the statement provided. So preliminary information required from worker enterprises. Preliminary information required from worker enterprises. Preliminary information required from worker enterprises. There are some questions here. Isn't a delivery van a motor vehicle? If you look at how we categorize vehicles and for investment allowances, we have ordinary cars, which we call saloon cars or motor vehicles. Then we have commercial vehicles. A delivery van is a commercial vehicle. Why we treat them, we handle them separately. For example, for ordinary vehicle like the saloon car, if this vehicle would have exceeded 3 million, I would have restricted. But for these others, we don't restrict. That's why we don't mix them. Because the cost could exceed the limit. If the cost exceeds 3 million, then you cannot go beyond 3 million. But these others like delivery van, you don't restrict. Or even if they were a lorry, you don't restrict. So you normally separate them for that reason. Because if you're used to putting them together, you would put them together, and yet maybe there are some restrictions required. So it's good to separate them. The first information, you say the business will require to produce. The business will require to produce, or will be required to produce. The business will be required to produce details. The business will be required to produce details of purchases and sales. The business will be required to produce details of purchases and sales. For instance, purchases and sales ledger. 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 Next information, all payment vouchers. All payment vouchers. All payment vouchers relating to general expenses. All payment vouchers relating to general expenses. All payment vouchers relating to general expenses in order to ascertain. All payment vouchers relating to general expenses in order to ascertain whether the expenses were incurred for the business. In order to ascertain whether the expenses were incurred for the business. In order to ascertain whether the expenses were incurred for the business. Next information, details of cost of goods sold. Details of cost of goods sold. Details of cost of goods sold, since it differs. Details of cost of goods sold, since it differs significantly. Details of cost of goods sold, since it differs significantly. Details of cost of goods sold, since it differs significantly with the amount computed. It differs significantly with the amount computed. Next, information is required on those transactions. Information is required on those transactions that were of a personal nature. Information is required in those transactions that were of a personal nature. Information is required in those transactions that were of a personal nature, as opposed to business. Opposed to business transactions. As opposed to business transactions. As opposed to business transactions. Finally, the usage of the business assets. 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 The usage of the business assets for private and business purposes. The usage of the business assets for private and business purposes. For private and business purposes. So look at the next investigation. That was pay investigation. Now we move to back duty investigation. So our next discussion is called back duty. So look at back duty investigation. Back duty investigation. So in back duty, it would be the examiner will provide information on assets and liability, the assets and liabilities of the business. Then we, as much as possible, will try to use assets and liabilities by preparing capital statements to try and estimate how much was the profit. Now, this would mostly happen where it is very difficult to prepare a statement because there are no records. Or if the records were there, the records are incomplete. So you make use of the information on assets and liabilities to prepare a capital statement and estimate as much as possible the profit or loss of the business. Now, back duty usually will arise where there is omission or there are no statements for a number of years, 5 years, 6 years, 8 years, and so on. So you have to get tax arrears over a long period of time. So back duty investigation is say back duty is a general term. Back duty is a general term. Back duty is a general term that is used to refer to the assessment. Back duty is a general term that is used to refer to the assessment. Back duty is a general term that is used to refer to the assessment of tax in arrears. Back duty is a general term that is used to refer to the assessment of tax in arrears. Then you say tax arrears may arise. Tax arrears may arise in case of tax arrears may arise in case of A, under declaration of income. Under declaration of income. Under declaration of income. And B, failure. Failure to declare the taxable income. Failure to declare the taxable income. Or C, the taxpayer may have prepared fraudulent financial statements. The taxpayer may have prepared fraudulent financial statements. may have prepared fraudulent financial statements. The taxpayer may have prepared fraudulent financial statements. New paragraph will say, a taxpayer will be considered to have committed an offense. A taxpayer will be considered to have committed an offense. A taxpayer will be considered to have committed an offense if there is proof. A taxpayer will be considered to have committed an offense if there is proof that willful, or gross negligence was committed, if there is proof that willful or gross negligence was committed, if there is proof that willful or gross negligence was committed by the taxpayer or his agents, if there is proof that willful or gross negligence was committed by the taxpayer or his agents. Next subheading, the sources of information, the sources of information, the sources of information in case of back duty, the sources of information in case of back duty, the sources of information in case of back duty. The first one, A, self-disclosure, during a voluntary tax disclosure program, self-disclosure during a voluntary tax disclosure program, during a voluntary tax disclosure program, or VTP, VTVP, voluntary tax disclosure program, VTVP, or tax amnesty, or tax amnesty, or tax amnesty, or tax amnesty. B, where former employees or business rivals, volunteer information, where former employees or business rivals volunteer information to the Revenue Authority, C, informers from the tax investigation branch, informers from the tax investigation branch of the Revenue Authority, informers from the tax investigation branch of the Revenue Authority. D, the media, whether print, broadcast, or social media, the media, whether print, broadcast, or social media, the media, whether print, broadcast, or social media. Then E, exchange of information between county offices of the Revenue Authority, Next, F, information from government departments, state corporations, and the registrar of businesses, and the registrar of businesses for any tenders that were granted to a taxpayer, or new business registrations, or new business registrations. Then G, personal identification number. Personal identification number or PIN. Personal identification number or PIN for various transactions. For various transactions requiring PIN. Such as importation of goods, application of electricity installation, or land transactions, etc. Next are the methods of computing and declared income. Methods of computing and declared income. When you say the revenue authority would normally insist on a complete set of accounts. The revenue authority would normally insist on a complete set of accounts to be produced, including a declaration of profit. Which is supported by credible or reliable records, and documents. Credible or reliable documents or records. However, in some cases, accounting records may not be reliable. Or may be unavailable. Then you say in such cases, capital statements may be prepared. Where sufficiently reliable accounts are not available. Next are capital statements capital statements. Capital statements. When you say a capital statement, a capital statement, a capital statement will consist of the details. A capital statement will consist of the details. A capital statement will consist of the details of assets and liabilities. A capital statement will consist of the details of assets and liabilities. At a given date, the details of assets and liabilities at a given date, showing the increases. At a given date, showing the increases, or in brackets, decreases. At a given date, showing increases, or in brackets, decreases in the net assets. When you say inventories, capital losses or gains, inventories, capital losses or gains, inventories, capital losses or gains are taken into account, including private living expenses, including private living expenses, and other information, and any other information, including private living expenses and any other information, to determine the taxable income. To determine the taxable income. To determine the taxable income. Then you say the increase in the net assets. The increase in the net assets. The increase in the net assets. The increase in the net assets is considered to be the income. The increase in the net assets is considered to be the income that is chargeable to tax. The increase in the net assets is considered to be the income that is chargeable to tax. Next up, heading, the steps in preparation of a capital statement. The steps in the preparation of a capital statement. The steps in the preparation of a capital statement. The steps in the preparation of a capital statement. Number one, obtain the total assets of a business. Obtain the total assets of a business. Obtain the total assets of a business. Obtain the total assets of a business over the specified period. Over the specified period of time. Obtain the total assets of a business over the specified period of time. Number two, deduct the total liabilities for each period. Deduct the total liabilities for each period. Deduct the total liabilities for each period. Deduct the total liabilities for each period to determine the net assets. Deduct the total liabilities for each period to determine the net assets. Deduct the total liabilities for each period to determine the net assets. Number three, determine the increase or in brackets decrease. Determine the increase or in brackets decrease in net assets. Determine the increase in brackets decrease in net assets for each period by comparing the net assets by comparing the net assets, of a particular period, with those of the previous period, Number 4, add back disallowable expenses. Add back disallowable expenses such as salaries to the house help. Add back disallowable expenses such as salaries paid to the house help, or private living expenses, Step 5, deduct non-taxable income. And other specified sources of income. Including investment allowances on the assets acquired and used for business purposes. New paragraph, you see, the resultant figure is the estimated total business profit. The resultant figure is the estimated total business profit. Then you look at May 2015, question 2. May 2015, question 2. May 2015, question 2. May 2015, question 2. Two B is called Mr. Sharma. May 2015, question 2B is called Mr. Sharma. So read the question. So Mr. Sharma has been trading as a general merchant since January 2011. The Revenue Authority discovered that Mr. Sharma had not filed tax returns since commencement of business. The investigations revealed that Mr. Sharma had not maintained proper books of accounts. The following details were obtained for the period from January 2011 to 31st December 2014. So, note 1 is on assets and liabilities from 2011 to 2014. So, you have trade receivables, trade payables, inventories, bank overdrafts, cash in hand, 10% mortgage loan, motor cars, buildings, wise bank loan, private residence. Two, he brought into the business a private pickup owned by his son, valued at 500,000 in year 2013. He had been repaying together with his wife the bank loan acquired by the wife. The mortgage loan was in respect to his private residence. 4, his living expenses amounted to 40,000 in 2011 and have been increasing at a compounded rate of 10% per annum. 5, in the year 2013, he paid school fees of 184,000 out of the business bank account for his children's education. 6, he disposed of a motor vehicle in 2014 for 800,000. The motor car had cost 1 million when it was purchased on January 2011. Capital deductions were agreed at 2.5% on the cost per annum of motor vehicles and land of buildings. He donated 42,000 to a fundraiser in aid of the local church in 2013. 8, he withdrew 200,000 from the business bank account in year 2014 to repaint his private residence. Upon completion of the investigation, the Revenue Authority issued an estimated assessment of 4 million shillings, which Mr. Sharma disputed. Required a capital statement for Mr. Sharma for the years ended 2012, 13, and 14. Advised Mr. Sharma on whether he should appeal against the estimated assessment. So step 1 says get total assets. So can you get total assets? Just pick your calculator, add the total assets. Let's have the numbers. For just the first year, 2011. So add up, get the total assets. That's our step 1. Umepata ngapi?
Okay.
6410. Na Thomas amepata ngapi? Total assets. Total assets za the first year 2011. Unasema ni 6410. I think it's more than that. Ni zaidi ya hiyo. Wacha to add. Trade receivables is an asset, si ndio?
Yeah.
So 194, hiyo ni asset. Inventories ni asset. 120. So plus 120. 120. Cash in hand 96. Motor cars 2 million. Motor cars need 2 million. Buildings 4 million. We are getting assets. Sindio? Private residence 3,400,000. Those are assets. So 9810. So in preparing capital statements, it is we include every asset. Why? Because the assumption is even the private residence was obtained from proceeds from profit from the company. So you can use even the value of private assets to help us. So we say less total liabilities. So we get the total liabilities for 2011. We have trade payables. Trade payables be 150. We have bank overdraft of 90. We have 10% mortgage of 16. 80, 10% mortgage. We have white bank loan of 900. So 2820. So that gives us what we call the net assets.
6990.
Net assets is 6990. Then we are supposed to get change, increase or decrease in net assets. Which is not possible in the first year. You can only get change from the second year. So we go on to 2012. We do the same thing. Get total assets, get total liabilities, get net assets, then get change. So we are in 2012. Total assets, we have inventories.
Then 532.
10,532 is correct. So we have 10,532. Then you get liabilities. Twenty-six, 28. That will give us net assets for how much? $79.04. Now you can get increase or decrease because it is $79.04 minus $69.90. So get an increase of how much? 914. Then you go to 2013 and do the same thing. 1104.
104.
Huh?
11104.
11104. Hiyo na doubt. 11104 na doubt. Hiyo na doubt, eh? But it could be correct, but 11104 no.
320 plus 300.
So it's 320, 320 is trade receivables, eh? Plus 300 inventories,
Plus 84.
plus 84, 84 ni bank, eh? Cash in hand, plus motor vehicles ni ngapi? 3 million. Plus buildings ni 4 million. Hiyo ni buildings, eh? Plus private residence 3.4. 11104 ni sawa. 11104. So this is 2450. So you can get your net assets. 8654. There's something we've missed, eh? There's something we've missed, eh? It's in note number 2. He brought into the business a private pickup owned by the son valued at 500,000 in year 2013. So you add 500 here. You know, got 11604. You add the pickup there. So 11604. We subtract 2450. And that gives us 9154. The 9154 minus 7904 will give you 1250. Change. When you go to 2014, so in 2014, you'll still add the 500, the pickup, because it is still there again in 2014. From 2013 onwards, the pickup is there. Yeah, it is 1104, then you add a pickup of note number 2. The pickup is 500,000, so it's 11604. Then after 2014, make sure you add the 500, the pickup. Inakuja ngapi? 10? 856.
You consider any disposal.
No, leave alone disposals. Disposals, will make adjustments for them. Eh? For now, just add assets. You get 10, 856. Liabilities ni ngapi?
Create
2380. So net assets, nothing? 8476. There's a decrease here. Of 678. So this increase or decrease in net assets is like gross profit before adjustments. Now begin adjustments. We'll say add back. So we start adjustments. Or 2380 is okay. So we start our adjustments. Our adjustments will begin from note number 4. His living expenses amounted to 40,000 in 2011. You can see now we don't have 2011. We only needed it because of changing net assets. Then we begin from 2012, which the examiner wanted. So we usually get a year earlier so that we can get net changing net assets. Now we no longer need this. So the living expenses amounted to 40,000 in 2011 and have been increasing at a compounded rate of 10% per annum. So you come here and add back living expenses. So here it was 40. So increased by 10% is 44 here. Then it's 48.4. Then 53.24. That's living expenses we've added back. They are not allowable. Then note 5, in the year 2013, he paid school fees of 184 out of the business bank account. So we add back school fees. In 2013, we add back 184. Note 6, he disposed of a motor vehicle for 800. We're going to look at that through a working note. 7, he donated 42,000 for a fundraiser in aid of a local church in 2013. We'll take that donation to be to a charitable organization, so we'll not adjust for note 7. Note 8, he withdrew 200,000 from the business bank account in 2014 to repaint his private residence. So cash drawings, or I just say drawings. He made drawings for personal reasons. In 2014, we add back 200. Then we say deduct. So we'll open a working note for disposal of motor vehicle. This is for motor vehicle allowances. Motor vehicle allowances. So we'll begin from 2011. So 2011, kuna motor cars were, so we have motor cars. So let me first put the year is 2011. So we have motor cars. And the motor cars are valued at 2 million shillings. So in 2011. Motor cars is 2 million. Then we get investment allowance in that year. Allowance at 25%. 25%, no, it's not 25. They said in note 6, it was agreed they used 2.5. So we use 2.5% for an allowance. 2.5% will give us 50. Then 2012, we call that residual, whatever is left. Residual value is 1950. So we're in 2012 now. In 2012, there's an increase in assets. If you look at the balance in note 1, motor cars in 2011 were 2 million. In 2012, there are 2,500,000. So there is an addition. Let's say addition. The addition is 500. This gives us 2450. Then you get our allowance. I'll just call it allowance. 2.5%.
Adjust camera kindly.
Yes.
Adjust camera.
So allowance will be 2.5%. This one will be 61.25. Then in 2013 is when the pickup is brought in note 2. And again, the motor vehicles increase from 2.5 to 500. So first of all, there's a pickup. A pickup vehicle of 500 from the sound. Then there are also additions. Then in 2014, there's the disposal. So in 2014, note number 6 says he disposed of a motor vehicle for 800. So use the actual disposal value, so disposal. So the sales proceeds was 800. That is what you use. You don't use the initial cost, but the sales proceeds. So we dispose 800, and we're left with we're left with 2504. Then we get our allowance. So this is the residual value at the end. On 31st December.
The fair value of the.
You use the sales proceeds, the actual sales proceeds. So you come here and see into vehicle allowance. So bring the allowances here. In 2012, the allowance is 61.25. In 2013, it's 84.719 maybe. In 2014, it's 62.6. Then there's a mortgage loan, 10% mortgage loan. You are allowed to deduct relief. It's called mortgage relief. Mortgage relief is the interest. So interest on mortgage, or let me just call it mortgage interest. So mortgage interest starting from 2012, it is 10% of the loan. 10% of the loan is 160. So we deduct 160. 10% of the loan, 10% is 152. And 10% is 146. Whatever is left is the estimated business profit. So starting from here, unachukua 914, una add 44, una subtract hizo mbili. So that's what we call a capital statement. So I think we'll leave it there because of time. We'll be able to advise for Roman 2 on whether he should be able to appeal. So we'll be able to do Roman 2. But that's the statement. But basically, we can even finish for Roman 2, you're supposed to get the total of this. You simply add the total taxable income. The total taxable income is going to be 736, 750, I'm writing them in full, plus 1245, 681, minus 633,360 should give us the total taxable income. $736, $750 plus 12, 45, 681 minus 633, 360. That will give us something 1349, 071. That's his taxable income. Then we'll use the graduated scale to calculate tax. Then we can compare that tax with we can compare that tax with what the commissioner wanted. The commissioner wanted 4 million. So that's where we'll be able to advise. So that's the income. Now let's calculate tax on that. We'll use the graduated scale because Mr. Sharma is an individual. So we'll say tax computation. Use the graduated scale. So we say on the first. So our current graduated scale, the first in our opinion. Hakuna 121. is the first to 88,000. The first to 88,000. You need 10%. 10% would be 28,800. Then the next 100,000. So how do I get 100,000? The graduated scale is from 1 shilling to 288,000, like that. Then 288,000 and 1. Inaenda mpaka 288,000. Then excess above 388,000. So in the first 288 at 10%. Nikitaka kujua the next, tunaona wanaanzia 288,001 because they want to exclude 288,000 because it was already covered. So they are starting from 288,001 to 388. I can still exclude by saying 388 minus this. So itakuwa the next 100,000. 388 minus 288,000. You exclude 288,000. Now that is at 25%. So that's 25,000. $25,000. Then you get excess. Excess above 388,000, about 1349, 071 minus 388,000. Now that at 30%. That should give us 521, 121.3. Then you add. When you add, you get 579, 921.3. Then you subtract personal relief. So that's personal relief. Personal relief is 28,800. Whatever remains should be tax payable. So 551, 120. But the commissioner is asking for 4 million shillings. So we can be able to advise him that he should raise an objection. So our advice is he should raise an objection. So Mr. Sharma should raise an objection against the estimated assessment of 4 million shillings from the revenue authority. So with that, you can also try a question. Let me give you November 2016. November 2016, question 2A. So you can go try November 2016. Question 2A. Later Mr. Moore. Mr. S. Moore. Oh.